Hey there! Welcome back to Control Your Money, the channel where we dive deep into the world of finance and show you how to take charge of your financial destiny. Today we have an exciting topic that's going to blow your mind. We're unlocking the secrets of fractional banking, and trust me, this is a game changer. But before we dive into the secrets, let's make sure we're all on the same page. What exactly is fractional banking? Well, my friends, it's a system that has a massive impact on the global economy. It's the reason why banks seem to have this magical ability to create money out of thin air. So, let's roll up our sleeves and understand how this whole thing works. Imagine this. You deposit $1,000 in a bank. Now, traditionally, you'd think the bank keeps that money locked away in a vault, right? Well, not quite. In reality, the bank only needs to keep a fraction of that money as reserves. Let's say it's 10%, so that's just $100. But here's where it gets mind-boggling. The bank can lend out the remaining $900 to borrowers while keeping your $1,000 on its books. Voila, that's fractional banking in action. Now, you might be wondering, wait a minute, doesn't this mean the bank is creating money? Well, my friend, you hit the nail on the head. When banks make loans, they essentially create new money in the form of electronic deposits. This expands the money supply, spurring economic growth and all the good stuff that comes with it. But let's not get too carried away. Fractional banking has its pros and cons. On the upside, it promotes economic activity by making credit more accessible, allowing businesses to expand and individuals to buy homes and cars. It's like a financial adrenaline shot for the economy. But of course, every rose has its thorn. The downside of fractional banking is the potential for financial instability. When banks create money through loans, it increases the overall debt burden in the economy. If borrowers can't repay their debts, it can lead to a domino effect of defaults and economic downturns. It's like a financial house of cards waiting to collapse. So, how does fractional banking impact you and me? Well, my friends, it affects everything from interest rates to the value of our hard-earned money. When banks create more money, it can lead to inflation, meaning the prices of goods and services rise over time. It's like trying to catch a runaway train. But fear not, money masters, because there are ways to tame this financial beast. Central banks, like the Federal Reserve, play a crucial role in regulating fractional banking and maintaining economic stability. They adjust interest rates, increase or decrease reserve requirements, and implement other policies to keep inflation in check. Now, let's take a closer look at the mechanics of fractional banking. To understand this, we need to dive into the mysterious world of reserve ratios. Reserve ratios determine how much banks need to keep in reserves compared to the loans they make. It's like a financial tightrope balancing act. Reserve ratios vary from country to country and are set by central banks. For example, if the reserve ratio is 10%, that means banks need to keep 10% of the deposits as reserves. The remaining 90% can be lent out to borrowers. But remember, this doesn't mean the bank can lend out the same money to multiple borrowers. It's a delicate dance, my friends. Fractional banking also plays a vital role in the money multiplier effect. You see, when banks lend out money, that money gets deposited into other banks, and the cycle continues. Each time, a portion of the new deposits is kept as reserves, and the rest is lent out again. This process multiplies the initial deposit, creating a ripple effect throughout the economy. But here's the catch. The money multiplier effect works both ways. When people start withdrawing their deposits en masse, it can lead to a downward spiral known as a bank run. This happened during the Great Depression, and it was like a financial tornado tearing through the economy. To prevent such chaos, central banks act as the lender of last resort. They provide emergency funds to banks facing liquidity shortages during a crisis. It's like having a superhero swoop in to save the day. Now that we've unraveled the secrets of fractional banking, it's time to wrap it up and reflect on its impact on the economy. Fractional banking can be a powerful engine for economic growth, but it also carries risk. That's why it's crucial to have responsible lending practices, effective regulation, and a watchful eye on monetary policy. That's a wrap on today's episode, Money Masters. We've unlocked the secrets of fractional banking, demystifying its inner workings and understanding its impact on the economy. Remember, knowledge is power when it comes to controlling your money. Thanks for tuning in to Control Your Money. Don't forget to like this video, subscribe to our channel, and hit that notification bell to stay up to date with our latest financial insights. Until next time, keep unlocking the secrets of financial success. Take care and control your money.